Okay, good afternoon, everyone. We're going to get started here. Hopefully you're here to learn more about the 2025 Tax Act, also known as the One Big Beautiful Bill Act. Your presenters today are myself, Nick Shires. I am the tax partner in charge of tax services here with Danable and McKee. Also presenting with me is one of our newest tax partners, Sean Connors. We both have a wealth of experience in this area of taxation and tax planning, and hopefully we can provide some insights into the new law that you can take away today. Before we get started, just want to do a quick reminder on the Conference IO app that we're using today to track your CE credits. So if you have any issues, you should have been prompted to open the app on your computer, grab it, log in. You just need your name and email address and use that to, you can use that to ask questions of us as we go through the presentation. You also will need to use the Conference IO app to answer our polling questions. There will be 4 of them as we go through our presentation. You will need to continue to do those. And then as well as that, we have an evaluation that will be done through the Conference IO app as well. And that will be available at the end of our presentation today. And we'd welcome your feedback and value what you think of our presentation and what we can do going forward to improve these as we continue to provide webinars like this. So with that, we're going to give you the opportunity to work out the kinks on the Conference IO app with our first polling question. There we go. We want to get an idea of your familiarity with the new law before we get started. I know you are all here, so hopefully nobody's checking that you have never heard of it. I think it's been pretty prominent in the news, so that would be a reason to stick around if you've never heard of it for sure. But I know that there are many of you that are familiar with it. Looks like we're getting some responses here, and good. So that's kind of what I expected. You know, a lot of people are somewhat familiar and looking to us for some guidance on some of the provisions within the new tax law. So what is it? That's a very broad question. So as you know, it was signed into law on the president's kind of self-imposed deadline of the 4th of July. So that'll be easy for us to remember. You know, a lot of the provisions are enacted on the date of the signing of the law. Some are enacted back retroactively, but we'll walk through all that. But an important date to remember is the 4th of July of 2025. And kind of nice that we got the new law passed during the summer as opposed to kind of late in the year. We've got a little bit more time now to kind of plan before we get to year end with some of the new provisions that are available. So nice that we got this during the summer, so we have the opportunity to utilize some of the benefits that are in there. The intention behind the new law was to provide some tax relief to specifically to workers, to our seniors, our retired citizens, and to businesses. Especially there's some provisions in here for small businesses that are the bulk of our clientele is small businesses, and there's a lot of provisions that are in this new law that were extended and set to expire after the creation of the 2017 Tax Cuts and Jobs Act, there's a number of provisions that we'll go through that you'll see were quote unquote temporary when the law came out in 2017 that were set to expire at the end of 2025. A number of those were extended and made now quote unquote permanent. But I think what we'll find is there were some permanent provisions within the Tax Cuts and Jobs Act that are now no longer around. So the definition of temporary and permanent are loose when it comes to tax law. And then you'll see there's a number of new provisions that we'll hit on as we go through this presentation. A number of these that were promised on the campaign trail back in the fall that have now come to fruition and are part of this law. So they are now in place. So we'll go through all of that as we go on. Sean's going to get started with going through some of the individual tax provisions.
Thanks, Nick. As Nick mentioned, I'm Sean Connors, brand new tax partner here at Danable. Happy to be with you. And yes, I'm going to be going through some of the individual tax provisions contained within the OBBA, also known as HR1. So prior to the passing of the TCJA, there were 7 tax brackets for individuals, with the lowest tax bracket being at that 10%, as you can see on the slide, all the way up to that 39.6% rate. Several of the brackets have been decreased with the passing of the TCJA. That top bracket came down to 37%. And as you could see, some of the other top rates have also come down a little bit there. In addition to the reduction in the top tax rates, the TCJA also modified some of the income tax brackets, which were the income for those brackets was increased, which effectively decreased the effective rate for pretty much all income groups across the country. So like many of the changes brought on by the TCJA, these rates and brackets were set to expire as of December 31st, 2025. However, with the passing of HR1, these rates and brackets have been permanently extended, which is good news for all of us taxpayers. Next thing I want to go through is the increased standard deduction and suspension of personal exemptions. So this was another significant change to individual taxation by the TCJA, which increased the standard deductions, and it also eliminated the personal exemptions. So I don't know if you can remember all the way back to 2017 tax year, but we had these deductions called personal exemptions, which allowed us to reduce our taxable income by a specified amount for the given year. I believe back in 2017, this amount was just around $4,000. And the deduction was available for every qualifying person on the return, whether that be the taxpayer, the spouse, or their dependents. As stated, the TCJA eliminated these deductions for the 2018, through 2025 tax years, and essentially replaced them with the increased standard deduction for each of the filing types. So as you can see here, pretty much every filing type nearly doubled, the standard deduction nearly doubled, going from the 2017 tax year to the 2018 tax year. These increased standard deductions, they've been adjusted annually for inflation, with the 2025 standard deductions being listed here. They are going to go to 15.75 for single filers, 31.5 for married filing jointly, and 23.625 for head of household. So if you look at the slides here for the pre-HR1 to the after HR1, these inflation numbers, they've increased from 2018 tax year about 25%. So over 7 years, about a 25% inflation increase there. With the passing of the HR1, the increased standard deductions are here to stay, which is great news. And in addition to the increased standard deduction, there's also a new temporary $6,000 exemption available for seniors age 65 and older. This new exemption is on a per taxpayer basis, so available if both you and your spouse are age 65 or older. You may qualify for this new $6,000 exemption. And it does have there are some income limitations on this new exemption. So just watch out for those. I believe they start around $150,000 of modified adjusted gross income. So just be aware of those income limitations to see if you would qualify on your 25 return. The next thing I want to cover here is the state and local tax deduction, also referred to as the SALT cap. So one of the biggest changes that affected many New York taxpayers created under the TCJA was the state and local tax deduction cap, which, as I said, is often referred to as the SALT cap. This provision capped the amount of state and local taxes an individual could deduct as an itemized deduction to $10,000 for all filers other than married filing separate filers, which the cap was reduced to $5,000. Because of this cap, it significantly reduced the number of taxpayers who were itemizing their deductions. Because in conjunction with the previous slide there, the increased standard deductions, both of them kind of worked against each other, and there was a significant reduction of taxpayers itemizing their deductions. The HR1 is going to modify this SALT cap. It actually increases it for the 2025 tax year to $40,000, and then has a slight increase for the 2026 tax year to $40,400. And then for the tax years 2027, 28, and 29, there should be a 1% inflation increase to the cap. So what does that mean? You know, I'm eager to see, I think Nick might be eager to see too, with some of our taxpayers here in New York who have, you know, just been taking the standard deduction these past years with the SALT cap. I'm eager to see if, you know, some of our clients will begin itemizing again because of this raise in the SALT cap. There is some things to note here with some of the phase outs. For 2025, there is a phase out of the increased $40,000 cap when your modified adjusted gross income reaches the $500,000 or more. That cap will start to go back down and phase down to the $10,000 limit that was previously implemented. And for 2026, that phase out begins at $505,000, and then so on and so forth for 27, 28, and 29.
Yeah, one question we've been getting a lot as this came out with the increase in the SALT deduction cap is whether the New York State plans to repeal the pass-through entity tax election. And there's no sign of that. And I believe there is still a definite benefit to utilizing the pass-through entity tax at the state level for your partnerships and your S corporations. You'll still have the deduction for real estate taxes. You'll still have the deduction for the tax on wages for an S corp owner in New York. So that deduction now will go up to $40,000. We'll have a lot more people itemizing, as Sean mentioned. But the PTET will still have a significant benefit. It'll allow you to deduct state taxes in excess of that $40,000 cap. So there still is a benefit to doing that election, and we will continue to do that for our clients here.
The next thing I want to discuss is the increase in the unified credit. It has been extended and enhanced. So this was a hot topic for a lot of our clients who are nearing retirement age, thinking about doing estate planning. With the TCJA, if you remember, prior to the TCJA, the estate and lifetime gifting exclusion was hovering right around $5 million. After the signing of the TCJA, that actually doubled to about $10 million back in 2018 and has been slightly increasing each year, with the 2025 exclusion being right around 14 million. I believe it's 13,990. So that was set to expire, like many of the other TCJA provisions, that was set to expire and revert back to pre-2018 levels after the 2025 tax year. Good news with the passing of the HR1, they have permanently extended and increased the unified estate and gift tax exemptions. The 2025 exclusion will be the 2026 exclusion will go up to $15 million per person, $30 million for married filing jointly. And also what is great about this is that on the federal level, this exclusion has what is known as portability, which means that any unused exclusion during a taxpayer's lifetime upon their death can be transferred to their spouse. So that is great news for taxpayers that have some unused credit remaining, and they can also try to avoid that estate tax that is very costly, as we know. The other thing I wanted to mention here, though, is that portability rule is for federal purposes only. If you are living in New York State or any other state, be sure to check the rules for the state. Here in New York, there is no portability, and the estate tax exemption is much smaller than the 15 million. I believe it's around 5 for 2025.
All right, so we just want to quick hit on the mortgage interest deduction. So that was extended with HR1, the 2025 Tax Act. Under the TCJA, there was a limitation for if you had acquisition indebtedness that exceeded 750,000, or prior to that, it would have to exceed $1 million. And we're seeing this more and more because of the prices of housing going up and up, and the rate of interest going up in the last couple of years. We're seeing this limitation come into play more often than we had prior to the implementation of the TCJA. But acquisition indebtedness, the $750,000 threshold has been made, again, we put permanent in quotes because we're not so sure what permanent means when it comes to tax law. Permanent until it's changed. And it also permanently allows for some lower income taxpayers to be able to use the mortgage insurance premiums on acquisition indebtedness. That gets lumped in as qualified residence interest and included as deductible interest. For like I said, for lower income taxpayers, that applies. So that was made permanent. It's a nice benefit in there for those that may be itemizing. Now we're going on to our polling question number 2. How concerned are you with the tax law changes? I know there have been a lot of questions and uncertainty that hopefully we can provide some solutions to here today, but just would like an idea of what your level of concern about some of these changes. It seems like the practice run helped. We're getting a lot more responses to this polling question than we got to the first one. That's a good sign. Yes, and we run the gamut here, not very concerned to concerned. So let's see if we can alleviate some of those concerns here. So, again, on the individual side, we had, in regard to itemized deductions, a lot of the things that got changed were related to the itemized deductions in the TCJA. The one goal from that tax law was to simplify tax filing, and it seemed to have accomplished that because the number of those actually itemizing their deductions on their returns went from about 20% of all taxpayers to about 5% of all taxpayers once the TCJA was passed. So really did simplify tax filing for the majority of taxpayers. Don't have to, track all of their itemized deductions, don't have to keep that paperwork on hand for 7 years. It really did simplify things. But one provision within the itemized deduction rules was the fees limitation. So basically taxpayers itemized deductions, if they were over a certain adjusted gross income level, would be reduced by about 3% of the amount that exceeded that specific threshold. So this limitation was eliminated with the TCJA, and it's permanently repealed by the 2025 Tax Act. They did put in a new limitation for taxpayers that are in the 37% marginal bracket, which for married filing joint taxpayers is going to be around $750,000 worth of taxable income. If you are in that tax bracket, there is a limitation on your itemized deductions of the lesser 2/37 of the lesser of your total itemized deductions, or the amount that your income exceeds that dollar amount where the 37% bracket starts. So kind of a complicated calculation to limit the itemized deductions that comes into play next year for our high income earners. Another item that was really simplified by the TCJA is the alternative minimum tax. So for those that aren't familiar with the alternative minimum tax, this was basically a separate calculation of your income and a flat tax rate. It really applied to a lot more people, a lot more taxpayers in 2017 and prior because of some limitations on itemized deductions, because of an exemption threshold. So prior to 2018, the exemption, you would reduce your alternative minimum taxable income by the exemption amount. And you can see for single filers, it was 120,000. For married filers, it was 160,000. The TCJA really drastically increased those exemption amounts. So it took a lot of taxpayers out of the alternative minimum tax. It ramped them up to 600,000 and 1.2 million. So you really had to be over those exemption amounts before the AMT is even a consideration. With the HR1, we're going to stick with those increased levels, coming back down a little bit to exactly 500,000 and $1 million. And that's again effective starting next year, 2026, because the TCJA provision was set to expire after 2025. So they put this in place for 2026, which should help keep most of our taxpayers still out of AMT. So we've also got not so good news. The TCJA eliminated the deduction for miscellaneous itemized deductions. So there were certain items, certain expenses that could be deducted as an itemized deduction, subject to a reduction of 2% of your AGI. So things like investment fees, fees you pay Danable and McKee to prepare your tax return. But most prevalent was the unreimbursed employee business expenses. So we saw this a lot with, people like traveling salespeople or those that are on the road a little bit that have some unreimbursed travel expenses or other unreimbursed business expenses that they're incurring as part of their job. That was eliminated. So the other item that has changed, so that was eliminated with the TCJA. The HR one permanently eliminates the miscellaneous itemized deduction. Another item that was changed is the educator expenses. So typically, if you're a teacher, you buy supplies for your classroom, you could deduct $300 above the line. They've switched that to an itemized deduction starting in 2026. And have increased who can, it's eligible for teachers. It's also eligible for instructors, counselors, even administrators and coaches, principals, aides, anybody that basically works for a school for 900 hours or more can claim the deduction, but it's now an itemized deduction and it's no longer above the line on the first page. So a little bit of a downgrade there for our educator expenses, and bad news with the elimination and making it permanent, the suspension of the miscellaneous itemized deductions.
And now I'm going to discuss some of the changes on the limitations on wagering losses. So with the explosion of online sports gambling in recent years, we thought it would make sense to touch on some of these changes to the taxation of gambling winnings and losses. So pre and post TCJA rules for deducting losses on wagering transactions, where that taxpayers could only deduct losses to the extent of their gains from such transactions. So with the passing of HR 1, this rule has now changed to where taxpayers are only now allowed to deduct 90% of those losses. So this could be a pretty big change for those of you that are doing any of the online sports gambling or just any gambling really in general. But a quick example of kind of how this works would be if a taxpayer has $10,000 of gambling winnings and $10,000 of gambling losses. In previous years, there would be no tax effect as both of these net to zero. Going forward and effective starting in 2026, if you had this exact situation, you would actually end up with $1,000 of phantom taxable income that would need to be reported on your return. So kind of a negative change here. As we've had some taxpayer friendly ones, this one kind of is not very taxpayer friendly. This is another big one, and this is one that President Trump, was a hot topic for him on his campaign trail, and really ran on this, where his promises for taxpayers to not pay any tax on their tip income. The new 2025 Tax Act does address the no tax on tips, but it doesn't quite fulfill the full promises that the president had on his campaign trail. So how does it look? So prior to HR 1, all tips, whether they receive cash, on credit, they were all reportable income. Employees were required to report these tips to their employers, who would then withhold income and payroll taxes on the tips while also paying their share of the FICA taxes. With the passing of HR 1, there is a temporary deduction now that is going to be effective for tax years beginning 2025 and going through 2028. The deduction is up to $25,000 per tax year. It does have some phase out limitations based on your modified adjusted gross income. So once you get over that $150,000 of modified adjusted gross income for single filers or $300,000 for married filers, this deduction does begin to phase out. There are some additional rules for claiming the deduction. Married taxpayers must file jointly on their returns to claim this. And then also the IRS has come out to say that They will be publishing a list. I don't believe they've given us a date yet on when that list is gonna come out.
There actually isn't.
Oh, there is now.
It's gotta be done by October 2nd.
Okay, October 2nd, so.
My son Parker's birthday.
So yes, October 2nd, the IRS is to publish a list of occupations that customarily receive tips. So the reason why they're doing this is so that employers who normally and customarily do not tip their employees, like us, you know, I don't receive any tips. I would, but they can't just start tipping their employees to kind of escape the tax. So we'll be on the lookout for that. And then another one here that was a hot topic on the campaign trail was the no tax on qualified overtime pay. So as you already, you know, everybody already knows what is overtime pay. It's when you work over 40 hours in a work week, and that compensation gets treated just like your regular pay in that it is fully taxable. Employees receiving the overtime pay would pay regular income and payroll taxes on these wages. So what does the 2025 Act do to qualified overtime pay? Well, it implements a new temporary deduction. Again, just like the tips, it's effective for tax years 2025 through 2028. And it is available for both itemizers and non-itemizers who receive this qualified overtime compensation. So it is a deduction that is available to you even if you do not itemize. How much is the deduction? Well, it's $12,500 for single filers and it's $25,000 for married filers. This, like the tip, the new tip deduction does phase out. Has the same phase out ranges for the overtime pay, starting at that modified adjusted gross income of 150 for single and 300 for married filers. And again, they stuck that rule in there for the married taxpayers. To claim this deduction, you must file a joint return.
Yeah, and just on the overtime pay, you can see that it's effective January 1st, 2025, even though this bill was passed and that became law on July 4th. So there's 6 months in between when it is effective and when it was an actual law. So there is going to be, you're probably thinking, how do you report that as an employer to your employee if you weren't properly tracking it, not due to your own fault, but because you didn't know this was coming. There is going to be some transition relief provided by the IRS for what is due to be reported to your employees on their W-2s so that they can properly claim the deduction when they file their individual tax returns. But we're still waiting for that from the IRS. It's going to take a little bit of time before we have that.
We've got a couple of questions come in privately, and do you want us to tell you what the questions are, or you want to wait to the end, or how are you doing on time?
We're gonna keep moving here, so
Okay.
if we don't get a chance to address your questions here during the presentation, we will certainly make sure to follow up with you individually. Like I said at the beginning, there's a lot. This law is almost 1,000 pages, and there's a lot for us to touch on. We will try to address your questions as we get towards the end of the presentation, but if not, we will follow up after on a one-by-one basis. The HR1 came across with this new deduction that's allowable for on your individual tax returns for interest you pay on a loan for the purchase of a new vehicle, subject to some adjusted gross income limitations. But any vehicle purchased after 2024 and prior to the end of 2028, so basically a 4-year period, 25, 26, 27, 28, you purchase a car, you can deduct the interest on that up to a total deduction of $10,000. The car must be a personal use vehicle. The use has to start with you, so it has to be a new vehicle. This doesn't work for a used vehicle. And vehicle must weigh less than 14,000 pounds. So it's just a standard passenger vehicle that is new to you. Then we've heard in the news a lot about the Trump savings accounts, as they're dubbed. So these are kind of interesting and kind of unique. They're kind of a mix between an IRA for your children and a 529 plan. The funds can be used later for qualified education funds, or it can essentially turn into an IRA for your child when they turn 18, and it's subject to those same distributions from it that are not exempt, are subject to the same 10% penalty that an IRA distribution would be until they reach the age 59 and a half. So this is kind of something to supplement. If you've got a child under the age of 18 that is working and has earned income, you'd want to set up a Roth IRA for them or a traditional IRA. This would be in addition to those limitations. You may want to put in additional. So it's a non-deductible contributions to these accounts can be made up to $5,000 on an annual basis. One interesting item is the parent's employer. So you can contribute, the employer can contribute up to $2,500 tax-free. So you get a deduction for the $2,500 that you put into your employee's child's account. So that could be an option. We're going to see if any governmental entities or nonprofit organizations set up similar funds that would be, they would have the opportunity to contribute unlimited amounts to these accounts for kids under the age of 18, but you can't set up a nonprofit to contribute to a specific child's account. It has to be within a group, qualified group. So the reason this is in there is because the federal government is going to start everybody under a certain income threshold with $1,000 account. So I think we will see in the next slide. Yeah, any US citizen born in the next 4 years between 2025 and 2028 with a social security number are going to receive a $1,000 contribution. We did the math a little bit this morning. On an annual basis, there's 3.6 million children born each year in the US. So that equates to 3.6 billion over 1 year. Multiply that by 4, we're at almost $15 billion going into accounts for children born. So if you're trying to do some family planning, you may want to start that at some point this year and make sure that as we approach the end of 2028, good tax planning, good financial planning is to make sure your child is born before the end of 2028. Don't want to miss out on that $1,000. Contributions must be invested in mutual funds or equities that are primarily US equities. Once the account owner becomes the age of 18, it effectively becomes an IRA with penalty-free distributions once they hit retirement age of 59 and a half. So still the greater benefit is doing a Roth IRA where that is not tax distributions are not taxable. Non-deductible contributions can be withdrawn tax-free, similar to an IRA, and those tax-free contributions and investment earnings are taxable to the recipient. And so qualifying distributions can be made without being subject to the penalty, similar to an IRA if that's used for education, or if it's used as a first-time home buyer. And the first date contributions can be made are a year from implementation in July of next year. Sean's gonna go through some of the business provisions.
Yep. So another big win in the 2025 Tax Act for small business owners of pass-through entities such as partnerships and S corps, and also for owners of sole proprietors, is the extension of the 199A deduction, also referred to as the qualified business income deduction. This provision, which was created under the TCJA, allows owners of these types of entities to take a 20% haircut of their qualified business income for the year on their individual income tax returns. There are some restrictions for the high earners with some wage and property threshold limitations. And then there are also some limitations for owners of what are known as specified service trade or business, like Nick and I, accountants. So in addition to the extension that was passed with the 2025 Act here, the HR 1 also created a new minimum deduction for QBI of $400. How does this work? Essentially, if you are a taxpayer and you have at least $1,000 of QBI income for the year, that rate jumps up to 40%, and you can get a minimum of $400 deduction. Anything over that, it would be back to the 20% deduction. It also the Act also increases some of the phase-in thresholds for the QBI limitation. So where those wage and property tests come into play for the high earners and also for the owners of the specified service trader businesses, some of those phase-in thresholds have been increased with HR 1, and these changes are set to take effect 1/1/26, just like some of the other provisions with the TCJA that were set to expire in 2025. This kind of picks up right after those expire in the 2026 tax year. Oh, looks like we have a polling question here. Do you think the OBBA tax changes will make it easier or harder to file your taxes? I think in some areas harder, in some areas easier. This could go either way.
It's gonna make it harder for us having to clients down again for their itemized deduction paperwork, because we're gonna go back to more people itemizing. But we'll see what everybody else here thinks.
Yeah, it makes sense. So a lot of people are saying harder, it'll be harder to file your taxes, and it does make sense. There is some new deductions that, that require some more gathering of information from both the individual taxpayers, the businesses. So yeah, I can definitely see that taxes on both ends, the preparers and for the taxpayer, may be a little bit harder going forward. Perfect. Okay, so the next two topics I'm going to be covering are both huge wins for both small businesses with the code 179 enhancement, and then the next topic will be for the bonus depreciation. But for the code 179, for those of you who don't know, this code section allows you to immediately expense qualifying tangible business property. So if you're placing in service qualified tangible property during the year, if you're a business owner and you buy some equipment, or you're buying some vehicles, whatever the case may be, this code section under 179 allows you to immediately expense that, the cost of that equipment, rather than depreciating it over its recovery period. For the 2024 tax year, this expensing limitation was 1.22 million. And then there's also a spending cap on the amount that you can place in service during the year, which starts to reduce the expensing limit that you're eligible to take. That cap for 2024 was 3.05 million. And once you got to the 4.27 million, you were, out of deduction. You couldn't claim any 179. So what does the 2025 Tax Act do to 179? Well, it increases both the expensing limitations and the spending cap, and pretty sizably too. It more than doubles the expensing limit starting in 2025. This goes to $2.5 million, and it increases the spending cap to where, you start to get phased out of the 179 to $4 million, all the way up to that 6.5, where you would completely lose the eligibility to utilize 179. These figures, like many of the other provisions in the new tax bill, they are going to be adjusted annually for inflation going forward. And then, like I mentioned, another big win for, really all sizes of businesses, small to large, is the return of the 100% bonus depreciation. So under the TCJA, bonus depreciation, which allows you, again, to write off the cost of the qualifying property placed in service, it increased the bonus rate percentage to 100% for the tax years starting in 2018, running through 2022. Included in the TCJA was a reduction of the bonus depreciation rate for tax years 2023 through 2026, which we've seen over the past couple of years. So each year has gone down 20%, with 2024's bonus rate being that 60%, 2025 going to 40, and then 2026, 20, and then fully phased out in 2027. The HR one, it permanently reinstates the 100% bonus depreciation, which is great. Like I had mentioned, for large businesses who may be putting in a lot of equipment and tangible property into service each year, that have gone over that section 179 expensing cap. The great thing about bonus depreciation is there is no expense cap and there is no spending cap. So it's available to all size businesses. The new 100% rate is eligible in 2025 for anything that is placed in service, any of the qualifying property that's placed in service on or after January 19th, 2025. And then one new thing relating to bonus is the new code section 168N, which will allow 100% bonus depreciation for what is known as qualified production property, QPP. Essentially, qualified production property is non-residential property that's used as an integral part of qualified production activities. So what is that in layman terms? Essentially, this is going to be your facilities, pretty much anything on the manufacturing side that goes into making your product, right? So we might, if you're thinking about expanding your facility in the next couple of years, this might be a great opportunity for you to write off a lot of those costs, as you would be eligible for this 100% bonus depreciation rate on that project if the construction of it starts after January 20th, 2025 and before 12/31/2029. If you are doing construction during that time, just remember here that that needs to be done and placed in service before January 1st, 2031.
All right, so this was a big one. The code section 174, research and experimental expenditures. So as part of the TCJA, in an effort to kind of afford some of the tax cuts at the tail end of the timeline for the TCJA, beginning in 2022, research and experimental expenditures, which are typically prior to 2022 expensed immediately, expensed when they're incurred. Those were now, beginning in 2022, required to be capitalized and then amortized over a 5-year period. So what we saw is, particularly with our manufacturing clients, were hit the hardest with this. We also have architects and engineers that realize that, spend a lot of money on research and experimental costs. They were hit pretty hard. You have to basically capitalize those expenditures. So you pay the money out to afford the wages and the supplies for your research and experimental costs. And now you don't get the deduction for those. So now you have to pay tax on cash that is no longer on hand. And we created essentially what we term phantom income for taxpayers that are performing research and experimental activities. So that was a huge concern and a huge item that we had to address back in 2022 and has continued for 2022, 2023, and now for 2024 as well. The 2025 Tax Act reinstated the immediate expensing of that beginning in 2025. So for our 2024 items, that's going to be still required to be capitalized. And depending on the size of the taxpayer, how do we recover those previously capitalized expenses is going to be determined based on your size. So you can see here, a small business taxpayer, which is average annual gross receipts of less than 31 million. So that's your 2022, 23, and 24 average revenues. Yeah, you can amend your tax returns from 2022 through 2024 to claim the expense in those particular years. Or you can take that deduction, the amount that you've capitalized that has not yet been amortized, either over a 1 or a 2-year period. So you can take it all in 2025, or you can take it in half in 2025 and the other half in 2026. So what we're doing for all of our clients that are in this scenario is kind of running an as if scenario for each of them. When does it make the most sense based on the tax rates, based on their anticipated income for 2025 and 2026? When do you get the best bang for your buck for reclaiming those expenditures? So there's a definite planning opportunity for those small business taxpayers under 31 million to get the biggest bang for those expenses in the particular year that they were incurred. Or is it better to look forward and claim those deductions in 2025 or 2025 and 2026? Little less flexibility for large business taxpayers. You can do it over a 1 or 2 year period beginning in 2025. There's not an option to amend to claim those deductions going backward. And the reason for that is it was a required method of accounting change in the method of accounting back in 2022. So we're still awaiting guidance on how do we unravel that? How do we go about amending the returns? There's some complications if it's a partnership that's a small business taxpayer with the rules related to amending returns for a partnership, an added layer of complication. So these are all items that we're addressing with our clients, trying to identify the best course of action going forward, knowing that we still need to get some specific guidance on how to do this logistically from the IRS. And I'll go through a couple more provisions pretty quickly here. So the business interest limitation, this is another taxpayer positive item. Again, in 2022, so you can get a deduction for interest expense as long as that interest expense is less than 30% of your adjusted taxable income. And adjusted taxable income prior to 2020 2022 included an add back for your depreciation, your amortization. So basically it was 30% of EBITDA. 2022 through 2024, no longer can add back that depreciation. So if you take big accelerated depreciation under the 179 and bonus provisions Sean talked about, those don't get added back. They drastically reduce your income. You may be subject to a limitation on your interest expense because you drove your income down by using depreciation expense. Beginning in 2026, that provision goes away, and now you go back to the EBITDA formula under the 2025 Tax Act. Qualified small business stock. So this was expanded and increased. Typically, you could exclude gain, potentially up to a $10 million gain on small business stock stock in a C Corp that you acquired directly from the corporation. If it's a small corporation with assets less than 50 million, you could exclude a gain on the sale of that stock up to $10 million. So that's been enhanced. That's now a $15 million potential exclusion, and the size of the corporation has now been increased. So corporations up to 75 million in assets can now qualify as a small business. That one's new.
Yep. So one of the changes with the 2025 Tax Act is dealing with charitable donations for C corporations. So prior to the 2025 Act, C corporations were only eligible to deduct charitable contributions up to 10% of their taxable income. Any of those disallowed contributions that didn't make it, that were over the 10%, were allowed to be carried forward up to 5 years. And then the 10% limitation applied to those carry forward contributions. So if you had carry forward contributions coming into the year, that same 10% test would apply. So what were the changes in the 2025 Act? The HR 1, it implemented a new 1% taxable income floor for deducting corporate charitable contributions. So what does that mean? That means at least if you make a charitable, if you're a C corporation, you're making charitable donations, to get benefit for that donation in any given tax year, that donation has to exceed 1% of the taxable income for the year for the company. Just to note here, the 10% limitation does still stay in effect. So they do work together, and then any of the contributions that are disallowed in a given tax year due to either the 1% floor or the 10% ceiling, those can still be carried forward for 5 taxable years. And this comes into effect 1/1/26. Real quickly, I'm just going to touch on the Qualified Opportunity Zone programs. So this was created under the TCJA. Essentially, this was to provide incentive for investors to invest in distressed communities across the country. It allowed for a temporary deferral of tax by investing gains that taxpayers had into a Qualified Opportunity Fund, a QOF, as long as they did it within 180 days of realizing that gain. The QOFs these are businesses that are organized specifically to invest in Qualified Opportunity Zone property. So essentially, one of the rules here is they must have 90% of their assets be invested in Qualified Opportunity Zones. So what was the benefit here? So the benefit essentially was, if you were an investor and you held your investment in one of these QOFs for 5 years, you essentially could reduce that gain that you had deferred by 10%. If you had held it for 7 years, it would be 15% reduction. And if you held it for 10 years, you would have a full exclusion. So what are the changes related to the 2025 Act? Well, the 2025 Act is going to permanently extend these QOZs. Essentially, what they're going to do is every 10 years, they're going to reassign Qualified Opportunity Zones. That's going to come straight from each of the state governors. They're going to propose the new QOZ designations. These new designations are gonna roll through as July 1st, 2026. And really, none of the rules have changed that much. The only thing that really changed is that the 7-year holding period has now been eliminated. Another thing here that changed with the 2025 Act is the excess business loss deduction. So this was a code section 461L that was created under TCJA. It applies to non-corporate taxpayers, and essentially what this provision is it limits the amount that an individual taxpayer can deduct when their trader businesses, all of the trader businesses that they own have a net overall loss. So there's a formula essentially that you would have to run through, but the limitations would go for $250,000 of deductible loss for single filers and $500,000 for married filers. And then any excess loss that was not able to be deducted in a given year would be treated as an NOL carry forward. What are the changes to this section? Essentially, it makes the excess business loss provisions permanent for taxable. It's going to be effective for taxable years after 2026, so 2027. And then it also increases the specified amounts just a little bit here, nothing crazy, going from 250 to 313 and then 500 to 626.
All right, now that we have time, I want to get you to your fourth polling question so we can get through that. But on the credit side, so some of the individual credits, like the child tax credit, the dependent care credit, those have all been extended. They were set to go back to pre-2018 levels. They've been extended and enhanced slightly. The big item I wanted to hit on the credits is the energy credits. A lot of those are going away at the end of this year. So if you've got improvements to your house that you're going to be doing, if you are going to look to buy an electric vehicle, those credits are now terminating at the end of this year. So windows, doors, get those all installed here in 2025. I think that is, once this is done, that is all the time we have for today. We thank you for joining us. And like I said, we will try to answer the questions offline here and get back to you, because I know there are a lot of specific questions that have come from this law. So thank you for attending, and have a nice day.